I do think we're in a commodity bull market. Um, that bull markets and commodities you always have to be careful with, and are always going to have fits and starts. But I think we're in one. I think that the level of importance in what we just talked about seems to be greater than ever because of the need for the world that we want to shift to and the key input that these things have. Now, I guess you can say that in the history of the world we've needed these things, but it just seems that multiple years of underinvestment meets this continued level of demand, and there are going to be certainly imbalances that are going to lead to higher prices.
So there's a staggering amount of capital, and I think you've kind of touched on it earlier, parked in the U.S. money market funds. It's currently sitting near $6.5 trillion, and it's collecting interest rates at over 4.5%. As the Fed eases, if they actually do ease down to the levels that initially were thought, a flood of capital that's sitting in those money markets could soon seek new opportunities. Are the trillions sitting on the sidelines rocket fuel for the stock markets and other assets?
No, there's never such thing as money on the sidelines as a factor to move things. That money, a lot of that money came from savings accounts. And if anything, maybe it just goes back to savings accounts. Because we have to keep in mind, for every dollar that goes into the stock market via a buy, there's a dollar coming out via a sell. So there's never that money on the sidelines to power things. What drives prices is the urgency of that buyer. It's the urgency of that seller. So I don't look at that pool of money as sort of dry powder for those reasons.
I appreciate that. So, Peter, in your analysis, is the economy currently and markets currently late cycle or early cycle? And for analogy purposes, would you say it's like 1995 or more like 1999?
I think this post-COVID world, it's in an upside down cycle. If you break down the U.S. economy, the areas that are strong, and to me, this is the only thing keeping the economy afloat. It's the massive amount of government spending, whether it's via healthcare, from Medicare and Medicaid payments, since they're the dominant payers and the beneficiaries of all that healthcare spend. It's the TRIPS Act, the IRA, which obviously incentivized the building of these manufacturing facilities and also infrastructure as well. You have defense spending as part of that. You have anything related to AI spend, and then you have upper income consumer spending. That's what's keeping the U.S. economy on its shoulders. On the flip side, you have manufacturing that's been in a recession for more than 2 years now. Existing home sales are tracking at 30-year lows. You have lower to middle income consumers that have really reined it in because of the cumulative rise in inflation and being very, very value conscious and value seeking. Global trade, very muted. So it's an extremely bifurcated U.S. economy. It's a very bifurcated global economy. You have India growing at 7%. You have China slowing down. You have Germany that's flatlining, but Spain's growing. So there's an extraordinary amount of, and let's talk about the labor market. You have the pace of firings that's very muted, but the pace of hirings, which has slowed. So this is, like I said, a very upside down.
And full-time jobs, I believe, is closing in on 1.5 million full-time jobs lost.
Right. A lot of it's been part-time. So yeah. I can't find an historical playbook, to be honest with you.
So, okay. So it's an upside down cycle that you're, laying out here. Has the cycle been canceled? Because, I mean, it just seems like it seems as if, here we have traditionally, we've gone through all these cycles, the booms, the busts, the starts, the stops, the clearing out of all the risk that was taken during the previous part of the cycle, and then it starts afresh. But it doesn't feel like we've gotten there yet. And here we are, still experiencing growth in the markets.
Yeah, the economic cycle obviously has never been repealed. Absolutely not. Another aspect that complicates things and sort of ties into the economic cycle is, the level of the stock market. and in terms of helping to drive also that upper income spending. So to me, a determining factor of whether there's an economic downturn is if the stock market does pull back, if there's any sell-off or bear market of note, because then that can flow through upper income consumer spending, and that can be a self-feeding or self-reinforcing thing. So I don't know. It's a very unusual economic cycle. I mentioned the 2.5 year manufacturing recession. Well, at some point there'll be no more inventory destocking, and at some point there'll be some inventory restocking where manufacturing would actually improve. So I'm as confused as anybody, but I do think it's important to point out all these different moving parts because I hear people on TV, oh, the economy's good or the economy's not. Well, you got to do a little more under the hood analysis by making these sort of general comments because some parts are doing well and some parts are not.
Exactly. Yeah, I totally agree with you. So, okay, let's stay on this, the stock market and the spending concept here, but I want to take it over to tax receipts. The United States tax receipts are more correlated to asset prices than most other countries, with tax receipts lagging the performance of the stock market. When the stock market goes sideways or down, typically, the next year, tax receipts are down. Does the correlation there force governmental policy to be more asset price protective or even accommodative, which is also inflationary?
Well, I've really only seen it at the state level, particularly California, where their finances ebb and flow with the stock market. And after 2022 and that pullback, their budget deficit exploded to the upside. And now with the market rising, it's gotten better. At a federal level, I don't know. It definitely matters. The Clinton budget surplus was because of a slowdown in defense spending and capital gains revenue from the stock market bubble. There's no doubt about that. So yeah, it definitely matters. But here we are with the stock market at highs, and the budget deficit to GDP is still at 6%.
Right. Okay, so Peter, Warren Buffett's Berkshire Hathaway. I couldn't finish this part of our discussion without bringing this up. He had a cash build of $47 billion in 2011. By 2017, it swelled to $92 billion. By 2023, just a year ago, it reached a whopping $157 billion. 1 year later, today, the cash build has reached a mind-boggling $325 billion. It's bigger than the market cap of all but 27 public companies in the world. What does this massive cash build by Buffett say? What is it speaking to us?
On one hand, I can say, he's 94 and maybe he's just prepping a transition of some sort and giving the new CEO, Greg Abel, a fresh slate, to an extent, with having all this cash to do as he pleases. Apple just became a huge position for him, and I think it's only natural for him to trim it. Now, what he's doing with Bank of America, yeah, I think you can maybe ask some questions about why he's doing that. And then, to take that one step further, because of all the businesses, both public and private, that he is in, he sees a lot of things that are going on in the economy, whether it's, selling candy or the railroad or fractional jets or whatever, paint. He knows what's going on in the housing market. He's probably not happy with his residential housing businesses selling bricks and stuff. So maybe it's just he doesn't like these the multiples on stock. So it could be that as well. We can only guess, of course, but maybe I say that there's probably a combination of all of that.
So maybe the stock market being elevated, he's like, I can't find any good buys, or maybe because of his myriad of businesses, as you just said, he's able to get his finger on the pulse of the entire economy, unlike most other, people. And so therefore he's seeing something, or maybe he's using this moment in time where it looks like it could be an economic issue as an umbrella moment to create this cash cushion for the transition, which I think is very interesting, by the way, that you bring that up. So yeah, maybe it's a combination of all three.
Yeah, I mean, it's his indicator that people cite, the market cap to GDP ratio, and that's now like off the charts. So if he pays
Right.
attention to his own valuation metric, I guess you can connect the dot, and that's why he's raising cash. But like I said, at least from the Apple perspective, that was definitely an outsized position. And Warren Buffett still pays attention to valuations, and Apple that was trading at its peak at 33 times earnings. I think it's prudent to take some money off the table, even if you have to pay some taxes on it.
And he was always prescient in having money right before there was a fire sale on certain types of assets that he wanted to go shopping for.
Yeah, he understands being in the insurance business. He understands the importance of having a lot of extra cash in case of an emergency, and and also not only in case of an emergency, but also to be able to take advantage of things. But again, 94 years old, his partner passed away.
Mm-hmm.
I don't know what's going through his head in terms of how he wants to eventually pass the baton on. Is he waking up every day thinking he's 54 and can invest as he pleases with not thinking about that sort of human time clock, or is he beginning to think about his own mortality? I mean, that can be the case as well. I don't know.
It's interesting. I like that perspective as well. Are you of the view that geopolitics and election uncertainty have added to the gold positive sentiment in 2024 and helped to drive flows? And now with the election completed, the question is, what may the impact be in the short and long term for gold now that the election uncertainty is going to be removed? Clearly, after today, there's some merit here that, as gold sold off pretty hard today, but has anything really changed for the gold thesis here despite, the Trump victory?
No, not much has changed. Because debts and deficits are still going to do what they're going to do regardless. On the geopolitical side and its influence on gold, usually I don't like to tie the two together. Okay, some major event happens in the world and I need to buy gold. But the Russian invasion of Ukraine and the US and EU response in terms of freezing half of Russia's FX reserves, that had a direct and positive impact on the price of gold in terms of waking up parts of the world and saying, we own too many treasuries, we own too many dollar-denominated assets, and we need to have more gold on our home territory in our own protected vaults. So that was the geopolitical event that I think has been the most influential in terms of the price of gold and allowed the price of gold to weather the most aggressive rate hiking cycle in 40 years and strengthen the dollar. So to me, that's really the only geopolitical event to me that really has mattered for the price of gold.
Did election uncertainty play a role, do you think, leading up over the last 6 months?
I don't think so. Maybe on the margin, but we were going to have an election regardless, and notwithstanding all the angst, we were going to have a winner regardless. And we already knew what we would get with Trump, and we know what we would probably get with Harris. So I don't necessarily think so on a sustainable basis.
So, Peter, gold's been on many investors' lips over the last 6-9 months, however, not in many portfolios. 71% of investment advisors in the U.S., they hold less than 1% of gold. What ultimately wakes them up to substantially increase their allocation to gold?
Sentiment always follows price. So now that gold was hitting up till today, hitting record highs, and you saw ETF flows begin to rise, it's only when prices continue higher that investors will chase that. Now it's gotten people's attention, there's no doubt about it, but only beginning to get people's attention, because a lot of the attention the last couple of years has been, hey, I can get 5% in T-bills, why am I going to own a bar of gold?
and earnings should be increasing as oil has stayed low, the price of gold has stayed elevated. We're now seeing that starting to cycle through into the earnings reports, especially the ones that are coming up.
Yes, I definitely would think so.
So I'm going to throw a couple of stats at you. In 1955, the U.S. had enough gold to cover its liabilities to the other central banks and governments. In fact, gold reserves exceeded dollars abroad by 160%. By the time Nixon was taking the U.S. off the gold standard in 71, America was down to 25% of what it needed to make right. Today, assuming that the reported gold holdings are accurate, America currently has about 8 to 9% to make everything right. Getting back to just 25% coverage, gold would have to do a 3x. What path are you seeing for gold from here?
So that is a great analysis, and I think that's one of the ways of sort of trying to value the price of gold, looking at those historical sort of benchmarks, because we know there's no exact science to trying to value it. I guess to your question, without knowing exactly where it's going to go, yes, I do think it goes much higher. And I do think that, I don't know if we're going to go back to some of those ratios, but I think we can at least traject further towards them. No doubt about it. And, the most interesting dynamic for gold is, on one hand, let's just say inflation flares up again. Well, that potentially is going to be good for gold. On the other hand, and maybe that's because the economy is still pretty good or whatever, but if the economy rolls over, inflation may soften or maybe stay sticky, but then central banks will continue to cut interest rates, which could be good for gold as well. But gold is now an asset in a way competing with fixed income in certain people's portfolios. It's certainly happening at the sovereign level, and I know firsthand that it's happening for some at the individual level. So you could get, I know I've heard many upside price targets in gold, and anything is possible to the upside for sure. I think one of the tough decisions as an owner of gold and a bull on gold is, when do you sell? Do you hold forever? If you're managing client money from a risk management standpoint, when do you sort of take some money off the table? These are things that I'm sort of struggling with, is where is that right price? And I know I'll never pick the right price, but what you threw out is some of the things I think about when you start to debate in your mind what are possibilities on the upside here.
So would it be price? Would it be sentiment? Would it be allocation percentage? Where more people, because it's just not, it's not widely held, et cetera. But Deutsche Bank recently put out a chart that showed an almost 1-to-1 exclusive correlation between gold and debt. And, we're running $2 trillion fiscal deficits as far as the eye can see, according to the CBO, and that's without a recession, as you just mentioned. So if we entered recession, what are we going to go to? 3, 4, 5%? Who know? Trillion? Who knows? Point is that, is it maybe based on the selling of gold? Is it maybe based on Washington getting the fiscal house in order more than a number?
So one of the things that I'm beginning to think about is, who's going to replace Jay Powell? And if it's Kevin Warsh, to use that as an example, that name, who I think would be a really prudent and responsible central banker, in terms of monetary policy, that may be something that tells me maybe I should lighten up on gold. Putting aside where the state of U.S. government finances are at the time, I think he would be somewhat prudent. And So that's something that I'm beginning to think about. Now, that's not going to happen until 2026, but something that I'm thinking about, as opposed to, an easy money replacement for Jay Powell that would have me continue to stay in gold.
That's interesting. So, all right. So, Peter, silver is much more than a monetary metal, as it was for most of its existence. Now it's equally, if not more, an industrial metal. When Powell came out a couple of weeks ago with more soft landing talk and the next rate cut, even though it wasn't going to be 50, silver kind of responded as if it was expecting economic activity to pick up, just like an industrial metal would. What do you see ahead for silver?
So silver to me is the most exciting. Silver is just so interesting in the sense that half the demand is industrial, and still having those monetary characteristics, the jewelry characteristics, the silverware characteristics, and silver being still well below its peak in 1980 and its peak in 2011. So, even platinum too, I find very interesting. Just being so beaten up and just believing that there's still a lot more catch up to be had in the prices of these things. Now, in the short term, maybe, I don't know if Trump's policies will influence the implementation of solar, which is obviously a consumer of silver in the world. Maybe, I don't know. But to me, silver is pretty interesting to the upside, and I see more upside there than I do, at least in the short term, in the price of gold, after this pullback that we're seeing.
So platinum and silver have a lot of correlation to each other, and platinum is tied to hybrid vehicles, which seems like the masses of the people are choosing over the EVs. And so there's multiple folks, Larry McDonald is one, that have come on here and have said that you need to be looking at platinum because of the things you've described and because of what's happening with the choices with the hybrids.
Yeah, I think the hybrids have become really interesting to this story because there was the assumption that full-on EVs would replace internal combustion and you wouldn't need catalytic converters, and who's going to own platinum outside of jewelry, and certainly palladium too. Hybrids, I think, have given a second wind to the platinum story. So I do sympathize with that sentiment. Now, we do not own platinum right now. We own plenty of silver, but not platinum. But I am beginning to think about buying it.
And so where do you, what's your view and your analysis on the mining complex, the gold, the silver, the platinum group metals?
So there is no more maddening, frustrating industry to invest in than the mining sector. At the end of the day, it's a really crappy business where you don't have any control over the price at which you sell your product for, which obviously is the case for anything in the commodity industry, but it seems to be very pronounced volatility-wise with this, and ever rising costs in terms of digging the stuff out of the ground, and many having to be in jurisdictions that you really wouldn't want to vacation in. That all said, from a value perspective, yeah, a lot of them are still cheap, and I do think that at the end of the day, there's still a lot of catch-up that the mining sector is going to have relative to the physical.
And so, during the 70s bull run and the 2000s bull run, all-in sustaining cost prices were taking off throughout the decade, and they still managed to outperform the S&P.
Right, where now they're not. And
they're not. They have not.
They're not. I mean, I'll use Newmont Mining as an example of frustration. And just when you thought that they were sort of clearing the decks for upside, they have their own internal problems, and the stock drops 20% in a day. It's just the constant constantly getting beaten up by owning stocks in this sector. You can understand why people just don't want to touch it. It's like enough is enough. I've tortured myself enough over the years owning these things, and I think that's why, even with the price of gold being at record highs, give or take, that's why I still think that there's this level of disgust and even apathy at this point for this sector. Now, eventually that will end, as human nature never changes, and there'll be a love affair again with them. But I can understand the level of frustration in this sector. Makes perfect sense to me.
I can too, and I've asked that question to so many people, why they think this disconnect exists. And I think the frustration, the disgust that you just articulated is probably the bullseye answer. So, Peter, the world needs these critical minerals for everything, from AI data centers, crypto, solar panels, EVs, the electrification of everything, military weaponry, and more. Are natural resources basically the next global battleground where kinetic and financial wars will be fought over, creating the next haves and have-nots all over the world?
Well, I don't know if wars are going to be fought over it, but economic wars will be fought over it, and you can just see that with what China is trying to do, and the relationships they're trying to build, particularly in Africa and other parts. They know they need to get their hands on this, but we do too here. I mean, the U.S. government's negotiating with the DRC to procure supply, so everyone knows now the stakes that are involved in getting their hands on this stuff. Kinetic wars, I don't want to go so far. Economic wars, for sure. Who's going to get their hands on this stuff? We all know it's really important and that's why the commodity space right now, I think, is just so interesting. And all these clean energy people who thought, oh wow, it's such a great idea, but never cared about the details, maybe now are waking up to the actual facts that you need this stuff in order to power these utopian renewable dreams of yours. And it's not so easy getting it. And it doesn't all happen to be in the desert in Arizona or Nevada, that you have to go to other places to find it.
Well, so like you said, everybody knows it. You know, there's going to be economic wars fought over it. There has been economic war. That all seems very inflationary to me, to the commodity complex itself.
I do think we're in a commodity bull market. That bull markets and commodities you always have to be careful with, and are always going to have fits and starts. But I think we're in one. I think that the level of importance in what we just talked about seems to be greater than ever because of the need for the world that we want to shift to, and the key input that these things have. Now, I guess you can say that in the history of the world we've needed these things, but it just seems that multiple years of underinvestment meets this continued level of demand, and there are going to be certainly imbalances that are going to lead to higher prices.
Well, this has been a fantastic conversation. Before we wrap up here and I ask Peter the final question, I just want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. When you subscribe, we want to give you a free gift. It's the report that we wrote based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Peter as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video. It's now time for the Golden Nuggets segment. Peter, let's discuss portfolio positioning. Now that Trump's elected, what assets do you think can pop, and what assets do you absolutely want to stay away from?
So we really haven't changed anything going into the election, regardless of who would win. Certainly acknowledging certain sectors that were going to be highly sensitive to the outcome, particularly financials on the regulatory side, particularly anything related to M&A with Lena Khan leaving the FTC. We own Live Nation, for example, that benefited, but there was no way to really play that because you were just essentially betting on the election outcome. I think that the commodity trade was going to work regardless of who was going to win. So we're still sticking to that. So we really haven't changed much based on, or it's really changed anything at all based on going into the election, and we're not really going to change much post this election. But we sort of have prepared for a rise in long-term interest rates regardless, that maybe is going to be exaggerated by Trump and the tariffs and so on. So we've been more short duration bonds, trying to insulate ourselves from what, like I said earlier in the interview, that we're in a bond bear market and I don't want it to touch any duration. But just keeping our eye on a bunch of these things, because from a policy legislative perspective, the real question was what was going to happen to the Trump tax cuts. At best, they were going to get renewed. At worst, some of them were going to come off. I say some because I don't think all of them were. So legislatively, I don't know, even if the Republicans sweep and take the House, I'm not sure outside of extending them, what big things will come our way. It's really on the regulatory side, and that there's going to be some relief. But considering how much the financial stocks have rallied today, we might have pulled forward all the benefits just in one day.
That's amazing. Well, Peter, thank you so much for coming on to the Metals and Miners podcast, for being so generous with your time, analysis, and ideas. It's been awesome to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
So I just encourage people, when they do their analysis, don't do it at skin level. Dig deep and see what's underneath the hood. In terms of seeing or reading about what I write, I have a Substack as well. They can type in my name and get out and check it out. Writing on just daily macro market and economic stuff, and including investing positions that we have. And then on the wealth management side, they can learn about our firm at the website bleakley.com.
I will put all that information up on the screen. It'll also be in the description area for everybody to click through directly over to you, to your Substack and to your website. I've been following you for several years and watching your interviews. It's been a joy to have you on. And guys, if you're not connected with Peter on Twitter or through his Substack, you really need to get connected with him. You need to be listening. He shares a lot of insights that are very timely and important for what's going on in this very confusing market. So, Peter, I look forward to having you back on sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
Thanks, Gary. I appreciate having me on.
Just want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. When you subscribe, we want to give you a free gift. It's the report that we wrote based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.